All right, so it looked like the stock market's bracket finally got busted today. So we're going to talk about what today's move looks like in context of, what's been occurring over the last so many weeks, how bearish that makes us, and what that does to our expectations of an intermediate pullback that we've had here for a while. Is this the beginning of that? This is a common question I've gotten. Is this the exhale that we've been waiting for versus that 5-day losing streak that we pretty much have made up, in terms of the amount in one day today? So I'm going to break all that down in today's video. How significant is this yield curve inversion that's been so talked about today, and what we can make out of that. So let's go ahead and get started. Today is Friday, March 22nd, 2019. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 here on the market forecast chart. You can see that what the rally did, and I had a long-term chart on here because the reason why is the last time the momentum line fell this low, as low as we are now to extremes, pretty much under the first percentile. That's an extreme low, obviously. With the intermediate line still in the upper reversal zone, was August of 2017. Just to kind of give you some perspective of what August 2017 looked like, was right there. So we had a dip. Obviously, we were above the 200-day moving average. The 50 had been above it for a while. We're not that bullish, but that's how far up above. So we're not expecting, we're not going into a bear market here. And again, this week, as bearish as today was, that's what it looks like on the weekly candle. I mean, it was pretty much the whole range, right? Because we opened up higher, and we opened up near the highs of yesterday and then came down. So we were down a little bit, but you get the idea, right? We were just barely at the highs yesterday at the close. So this is pretty much the overnight trading, today's trading, including overnight trading, that whole week. I mean, look at the rally we had ahead of time into this. So again, big grain of salt. But yeah, one day of selling does not undo 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, with a dip, 11, 12 weeks of buying, right? That doesn't even do that. I mean, in fact, we barely closed down compared to where we were. Now, we did get a longer upper shadow today, which means that we can expect some weakness based on that candlestick pattern. If you look at the Hakinyashi candle, we had been getting some transition candles. We didn't quite get that transition this week. And we've seen this before. We've gone maybe a week, 2, 3 maybe, before we finally got the transition we were looking for. It might just be 1 week in this case. But you get the idea here that things are not as gloomy. I mean, yeah, we've got a sharp drop in short-term sentiment. The momentum line still, obviously did not get below 50 itself because of how big yesterday's gain was. That's kind of keeping the momentum line up. But you see how it's oscillating right around the midpoint. So it's not really bullish or bearish. It's just kind of up or down. Remember, we're down. We're kind of flat over the last week or so. So keep that in mind with a small bearishness, and so we're slightly below the 50th percentile, not above it on the near-term line. The intermediate line is still strongly bullish. Market sentiment still also rising and close to the upper reversal zone itself. So, and I've mentioned this before. I'll say it again. Any weakness we get it would just be weakness. I mean, this pullbacks, and that's it. I mean, Fibonacci retracements down to 2660. That's another 140 points away. It would be very uncomfortable for people, but it would essentially just be a retracement, right? It would just get you to the 38% retracement, the beginning of the retracement zone between 38 and 62. We're not entering bear market. I know there's a lot of recession talk today, especially with the yield curve doing what it's doing. In our technical analysis class that we have at Market Scholars, we spend a lot of time looking at the yield curve as a technical indicator. Because that's what it's being talked about, right? The market's going to go bearish now because of the yield curve. So we talked about what we can expect from a stock market based on the yield curve. So for you premium market scholars, make sure you check out the recording on the calendar of today's technical analysis class. I think you'll find that first 30, 40 minutes or so very enlightening for you. But you can see, if I take a look at the Russell, which has been showing weakness already, right? It fell below that low point. So the S&P is not there yet. That would be the 23% Fibonacci. The Russell tells us that we probably will get there. I mean, the Russell told us that we shouldn't have. I mean, the S&P got up to a new high. The Russell didn't. So the Russell told us, and we've been looking at it as a red flag earlier in the week. We looked at it yesterday, and we said, yesterday's move was not quite a risk-on move. And then today, obviously, dropping. We got a dark pink shading, intermediate lines below 50. And if you look at the line here, 55, 64 to 65, 1/100th of a point higher. So the line will be yellow on Monday. Most likely, unless we regain all of this on Monday, most likely it will turn dark red on. So it's yellow on Monday, but it'll turn dark red on Tuesday. It's got to turn down for it to turn red. And we're only 1/100th of a point higher. So it won't take much to turn it down. Just another day. We'll probably get it lower. You can see its near-term line also not dropping to extreme lows, but the momentum line did. Then let's look at the Dow. It's the other index that's been weaker. It hasn't. It like the Russell did not get a new high, but unlike the Russell, has not dropped below that low point yet. It is pretty bearish. It dropped below all those lows. It's got a bearish posture. It doesn't have dark pink shading like the Russell, and of course the Nasdaq Composite, which has been the most bullish. You can see nowhere even close to that. Not even close to getting below the moving average. The near-term lines barely crossed below 50. So you can kind of get an idea. Very bearish in the extreme in a one day. And we'll see if Monday and Tuesday if we follow through on that extreme or not. Because when you get that big of an extreme in such a short amount of time, it's hard to sustain that unless you're really breaking through some significant support levels, which right now we're not. Not even on the Russell 2000. We're just basically starting what may be finally an intermediate pullback like we got back here in July of last year. As always, before we look at some other charts, a reminder to subscribe to our YouTube channel so that way you're notified when these videos are posted. You can mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. Those of you on youtube.com, there's a subscribe button right below the video. Click on that. Very easy way to do that. There's also a little bell there on youtube.com that will send you either push notifications to your phone or email depending on how you have your settings whenever these videos are posted. So good way to keep up with what we're doing and when we're posting these. Also hit that thumbs up icon that's down below the video. That tells me, number one, you got something out of the video today. It was worth watching. Number two, you want us to do it again on Monday. Very easy way to give us feedback. You can do it in one click. You can do it right now while we're watching. Also down below, comment on anything that stood out to you. Love to see. We had some great comments in the video from last night. Comment on what stood out to you. That way when people come to the video, they see reasons maybe they should be checking out the video themselves. Join our daily market outlook email list. There's a link popping out in the top right corner of your screen. Click that link to subscribe. Very easy way to do that. Remember, Friday's email has daily clusters watch list as well, overbought and oversold, as well as weekly clusters watch list, overbought and oversold. So make sure you're subscribed to get those watch lists, as well as that timestamp summary of our videos. Follow me on Twitter for more content. I posted some things out today, so make sure you're following me to get that content that I put out there in between the videos, and then join our daily market outlook community that we've created on Facebook. Also, remember you can watch our video on our blog. There's other things in our blog too. Make sure you're checking those out. But these, you can come here for other links to other areas of our site, like our Market Outlook forum. You have to subscribe to our site to participate in those, but you can do that right here for free. Our calendar of upcoming classes, you can see Brandon's still gone on Monday, and then on Tuesday as well. So there's my next two classes here. And then of course we're looking for 3 clicks here. 1, click on this heart. That opens up this window where you can like today's Market Outlook tweet. 2, click on this image, takes you to your Facebook account, like today's Market Outlook Facebook post, share that with others. 3, click on this like button here. Alright, back to the charts. Let's take a look at that long-term chart again. And again, you can see that upper shadow, and that's on the S&P. Take a look at some of these others. There's your Dow Jones Industrial Average. Remember, not getting up to new highs. Look at that long upper shadow on the Nasdaq. Long upper shadows tend to be pretty bearish, just like long lower shadows tend to be bullish. Doesn't always have to. Look at here, you can see we didn't roll down in July. We did briefly for about a week before pulling back up. And then finally, of course, we didn't have quite the run heading into that when we had like a 2-week rally. And then finally, there's your Russell 2000. No long upper shadow because it's been a lot more bearish than, in fact, look at this, closing back down below the 50-day moving average. The only one, right? All the rest of them are all easily above a rising 50-day moving average, which is also above its 200. The Russell, it's not the case. Both the 50 and the 200 day are actually falling, and we're below both of them. So a lot more bearish look at the Russell than we're seeing. And again, a little, would suggest that's what we may see on the rest of these indexes. Not that would be, not that we'd be looking for big time reversals, just that it would suggest that we might get that intermediate pullback that we're finally going to get, which on the S&P 500 would get you down to that 2640 level. See, that would also get you below the 200-day moving average, 2660, excuse me, which is where the 38% Fibonacci retracement of this rally would be. See, that would be uncomfortable for a lot of people, most likely, but it simply would just be, at the time at least, a Fibonacci retracement. It could turn into more, but to get to that point, it would just be a Fibonacci retracement to get there. Let's take a quick look at the 3 green arrow chart. We do have one red arrow, so that as much bearish as we were, we only got one red arrow on the S&P. We do have 3 red arrows on the on the Russell. So remember, the Russell has a dark pink shading. It has the we'll have a yellow line tomorrow, most likely a red line on Monday, most likely a red line on Tuesday. And now it's got 3 red arrows with what will most likely be a red line on Tuesday. So you can see how, again, the small caps is suggesting the rest of the market, and it has been, right? We've noted this isn't new. We've been looking at this weakness in small caps for a while now, and it's suggesting that we're going to get more weakness in these other indexes like the NASDAQ and the S&P and the Dow for that matter too. Remember, if it wasn't for the Boeing, Dow would be right there where the S&P is. So this is suggesting we're probably going to get some more weakness in those other areas as well. Let's look at the 2-line version really quick of the S&P 500 of those 3 green arrows, and you can see today's weakness is as weak as it was, got us down to the 17-day moving average. So we're not, the stochastics crossed below its moving average, but the moving average is in the upper quintile. The MACD crossed below its moving average and is forming a divergence, and so that would set at least this 2700. At least that low point there as a potential target for where that divergence would be. Again, still above zero, so we're not in bear markets now. This isn't the day one of a recession, right? This is, as of right now, still just a pull. I mean, even the rally we had that preceded this was pretty strong rally off of that March 8th low point. Here's the intraday chart. In the intraday chart, no lower shadow. That was the open for the Hakinyashi this week. That open is going to move up into this area. So, in fact, I just looked it up. It's going to move up to 279.61. That's the midpoint of the Hakinyashi candle this week, of the body, the midpoint of the body. So that's where it's going to move up to next week. Let me get rid of this one. That's the close. That was the close of this week earlier today, so we'll move that. So, as of right now, we're going to have a lower shadow on next week's candle, and most likely will be another trend, depending upon where we open and how volatile we are up and down next week. It might be another transition candle where we have an upper shadow above that and a lower shadow below that. So, or if we gap down below this level and we never get above that, then we'll have a bearish candle just like that next week. So our transition will have now turned into that bearish. So you can see where we are with the midpoint of the 4-week range. We're just right there. That's not going to change because the low point's going to be there for a while. The high point's going to be there for a while until we move either one. Now that's different on IWM. IWM, we did get a new 4-week low point. So again, kind of would suggest where we're headed on the S&P 500 there. Might not be Monday, might not be Tuesday, but like eventually what happened in September and October of last year, we eventually got that weakness that we were seeing in small caps. Let's take a quick look at the volume and the range today, because remember how I said yesterday that we don't want to we had a good range yesterday of about, what was it, 4.5 points, and we said that's a bearish range. We don't want more days like that. Well, look, we got another day just like that, and it wasn't another bullish day, right? It was a bearish day, and we in fact, I mentioned that in last night's video. Bearish, another 4 point. Look at that heavy volume, 1.5 times, 121 million shares traded. Look at that in context. There's 121. That's bearish volume. It's not extreme. So that means that this sell-off might not be done. And then the volume, the range of 4.6 points, not extreme either, again means that we might not be done here. So if we had a 6-7 point range, if we had volume 150 million plus, then we could probably say, you know what, this is a 1-day extreme sell-off and we'll probably bounce. And we might bounce a little bit on Monday, but the volumes and the rising ranges and rising volumes, and for that matter also the rising volatility, which is now in the bearish zone, crossing all the way through the neutral zone, all of those would suggest that we're going to get a little bit of a point. Now remember that intermediate pullback we got last year, the one that's similar to what we're expecting now, it also got the volatility up towards 1. So this was not abnormal to get volume like this, and you see it got up to 18. It is kind of breaking out. If you look at like the Bollinger Bands here for volatility, you notice it is up to the upper Bollinger. It's been trading below the moving average this whole time. A little bit of a pop here and earlier this month to the upper Bollinger Band, then right back down with those long upper shadows. We did get a little bit of a long upper shadow here, so that's what it looked like last time when we jumped up to the upper band. We pushed it up a little bit. We got up in the upper half of the band width. It pushed the bands up a little bit. We didn't jump into this horrible ranges of volatility, and we might move up towards 18, 19, 20 like we did here. We might get that long upper shadow on Monday or Tuesday next week, and then kind of grind up above 15 for a while. Kind of grind up above this in this area here for a while, this bearish territory, without getting to an extreme. That will set our intermediate low point. That will be our exhale we're looking for. That will set us up for a bounce off a new higher low point from the Christmas Eve lows that we can look for a new intermediate run to start from. All right, so what do you think about that market outlook? I would love to have you vote now by clicking on that link that's popping out in the top right corner of your screen. Then opens up a poll. Then there's only 2 answers. Either hit agree or disagree, one or the other. If you hit disagree, scroll to the comment section below. Love to see what you're seeing or what you're thinking there that would suggest otherwise from what we just came up with our little market outlook process that we have here. All right, now let's take a look at how the price action performed here. You can see the S&P ended up being down on the week after being up about 1.25% going into yesterday's close. So there's the down move on the week. Of course, small cap stocks having the biggest loss. They were already lagging as it was, now down 3% on the week. So really, really big declines. Obviously, most of those losses coming just today alone. International stocks also dropping, not nearly to the extent, but more than twice as much as what the U.S. stock market's dropping. Preferred stocks also down. You can see on the upper end of things, not surprisingly, they have bonds rising. Crude oil is also positive. Usually crude oil is what's been leading stocks either up and down, but this wasn't a lot. This crude oil didn't drop down today, at least not as significantly as what we saw in the stock market. Here's the chart for crude oil. And you can see it's not anywhere close to like a steep pullback. It's still strongly bullish. And you remember after the yield curve inverted, and there's a lot of discussion about the yield curve inversion. And this is our chart here is based off the Fed data. It's still not updated as of right now. What would this be? Let's get to a daily chart. Looks like the most recent update's 321 on the 30-year, and on the 10-year you can see 320 there. 321. Let's see if I zoom in. There is 320. So this would be 321. That's yesterday. So we don't have 322 yet, but you can see there's the yield curve, yield spread, between the 2 and the 10. The 2 is the purple line right here. So look at over to the far right. That's the purple line. You can see it's falling a little bit. And then there's the 10-year there. So there still is a gap. Look at this red line. The red line is the 33-month Treasury yield. You can see it's actually not falling. In fact, it's still holding up pretty well. The 6-month is a yellow line. You can also see it's not falling very much either. In fact, what's really been falling from this level over here, far on November the 8th of 2018, that's when yields peaked. on all these across all these long-term levels, and since then we've been on a steady decline. Remember, stock markets bottomed out here December the 24th. That's where stock markets bottomed out. So right there, and then they bottomed out kind of again, a little bit of a pullback on the 3rd, but stock markets are way up to new, well past these November highs. At least the S&P 500, not the Russell. But you can see yields are not. So it's actually not so much the yield curve inversion. We've seen one of those before. It happened in the last time it happened was not 2007. I'm sure you read a lot of articles today that talked about the last time we've seen the yield spread this low was 2007. That was on the way up. If you notice, go back here to 20 years. The last time that the yield spread, and I tweeted about this earlier today, was this low. Was not here this August of 2007. It was actually back here in October 2005 was the last time the yield spread, and really in this time frame. And you notice something very similar. 2005, the red line, and actually would probably look more like right here. See, the Fed's done raising rates, right? According to the Fed Funds Future Market, the Fed stopped raising rates right here. And in fact, if I were to customize this time frame to look at just 2006, the last time the Fed stopped raising interest rates, right there in June, you can see preceding that last hike, yields had peaked, and going through that hike, and by a couple months later, there was an inversion of that yield spread, because the red line, which is the short term, and the yellow line, which is the 6-month, stayed flat after that yield, but everything else has been dropping. All the long-term yields, including the 10-year, drop below where those short-term yields are, because these will fall when the Fed starts lowering interest rates. Now you'll notice the odds of a rate cut have risen up to 58% now. So yesterday the odds of a rate hike were only 48%. 38%. We're only 38%. Now we're looking at a 58% odds of a rate hike. So it's a pretty big jump. A lot of it in the 2 and 3, right? So you can see how all of these just jumped a little bit, about 9 points. The rest of them also jumped too, about 8 points for 2 rate cuts by the end of the year. And you can see, June's are pretty much the next meeting at the quarterly schedule, and there's a small chance of a rate cut in June, but it's now by September that you get at least a 1 in 3 chance of a rate cut, and of course by December you're getting a 40% chance plus of a rate cut into December. So now the market's no rate hikes. The market is pricing in the odds of a rate cut, but you notice back here that they didn't cut rates until after. We had the yield curve inversion here in August, right in here. There's the 0 level. We dropped below it. We actually dropped below it immediately, right after the Fed raised rates here. That last time the Fed raised rates. But then we kind of were trading all these long-term lines. We're trading right around it as they were falling. Then we really got below it and stayed below it here in August. So that was actually a couple of months after the Fed hiked interest rates the last time. We're a few months away from the Fed raising rates in December. About 3 months now, obviously. So, but that being said, we're not. The Fed started cutting rates in September of 2007. The stock market peaked in October of 2007, a full year after all of this. So that's why don't read a lot into any recession calls of what's going on with the yield curve right now. In fact, if you notice, the biggest issue isn't the fact that we're inverting. The biggest issue is that they're rolling over. See, we stopped going up. And now they're going to flatten out. This is what happened before, all the way to June of 2007, and then they cut rates in September of 2007, and the stock market peaked right there in October of 2007. And that's where the stock market, again, we had a pullback. We started to decline. We bounced up in the stock market as well. And then we had where we really fell off the cliff. And the Fed was lowering interest rates that whole time. That's why these short-term aren't going to fall until the Fed actually does. Those odds of a rate cut really jump up to high probability levels. And again, that was just a little taste of what I covered in the technical analysis class today. That I went a lot more in depth especially in terms of where the market rotates into post yield curve when we get to this environment. Now, where is the money to be made? So Again, using the yield curve inversion as a technical indicator. So make sure you check out, for those premium Market Scholar subscribers, make sure you check out today's class for more in-depth. We went 30-40 minutes on that topic today. Let's take a look at the sector rotation. You can see obviously the biggest losers are your dollar sensitive areas, energy and materials and industrials. Technology was the biggest winner, right? It pulled back some more today as well. Financial struggling with this declining yield spread. On the other end, your interest rate sensitive areas, with yields falling as much as they have. I mean, look at this long-term chart of the 10-year note. Dropping way below. I mean, that's a pretty bearish level. I tweeted out a couple of days ago that the market usually is not, when the market rallied that day, that market usually doesn't rally on the days where you're getting clusters on the market forecast chart. We ended up not getting the cluster yesterday because we rallied off of the low point. We did have it at the beginning of the day. We ended up getting the cluster. Well, we ended up not getting a cluster today either because we came off the low point. Now, we did get the cluster on the weekly chart. Now, in the past, as I showed yesterday, that's usually been bullish for yields. Maybe not immediately. It might take a while to form a low point and then maybe even another extension lower. So we'll kind of keep our eyes on that. But we're we're in a bearish pattern right now for yields. Bottoms aren't formed in a day, but we're going to watch to see, now that we are so extremely lower from 3.25% all the way down to below 2.5% in such a short amount of time, what kind of impact that's going to have on bonds going forward from here. And in the rotation, obviously the financial sector is the one that suffers the most from that. Whereas with rates falling, utilities and real estate continue to be very, very strong sectors. I remember from that October the 3rd, I mean, even if I were just to go back, where's my sector? There it is, sector comparison. Even if I were just to go back on a 9-month chart here, so about 200 days roughly. If you take a look at your best performing assets, even with this decline that we had in stocks, it brought us down to and in this period 15% down, coming from a 6% gain. So that was a 20% drop. Even with that, you can see utilities and real estate are by far, and staples for that matter in pink, and healthcare, all your safe haven sectors are all your best performers. So the market's already kind of been looking at this weakness. People have already rotated into safety. Those are just, this is patterns. I've shown you the strength that we've had in these real interest rate sensitive areas for a while. So again, what does this tell me? This tells me that it's not like we're not expecting the market to turn down here and go haywire. We're not looking at fall of 2008 again. We're not even really looking at fall of 2007. Right? We might be looking at 2006, where the last time where we stopped raising rates and the yield curve inverted, or at least came close to inversion. And so that was actually bullish. The markets rallied for over about 25% from the time that the yield curve inverted in August of 2006 to its peak in 2007. The stock market rallied more than 25% to get to that level. And so this is suggesting that we could be due a pretty strong rally going forward in the long term, not in the short term, right? But you can see we don't usually start big bearish moves with big outperformance in safe haven sectors. We usually start it with big outperformance in the cyclical sectors, right? And the safe havens are lagging, and then they'll rotate up. Well, that's not the case right now. They have very strong outperformance. Your weaker performers have been energy and materials and communication services, as well as financials, of course. So again, your cyclical areas are lagging or kind of matching the market on this weakness. That tells us that we might get a little bit of weakness now. It's not long term, and we can actually expect to use any intermediate pullback as potential for a good long-term move higher going into the end of the year, beginning of next year, with a good move higher in some of these underperforming areas over the past 9 months. All right, so for today's trade example, I wanted to look at Under Armour. Under Armour's got this kind of classic head and shoulders top forming that we're now breaking through today. The trend line, the neckline that you would cross below these low points with. Breaking with 3 red arrows. You notice also that the moving average isn't red yet. It won't be on Monday. It's gone from 2179 to 2180. So it's only 1/10, so it probably will turn red, barring any big jump to the upside here. So we'll have 3 red arrows, most likely in another day with a red line. The market forecast will also show in probably another day, dark pink shading. The intermediate line will drop below 50, most likely, barring any big jump. Dark green, pink shading, as well as a red line eventually, and probably, again, not on Monday, but probably Tuesday, that line will turn red. You take a look at its long-term view here on Under Armour, and you can see it had been struggling anyway, and looks like now it's going to roll down towards. In fact, if you look at the Bollinger Bands for Under Armour, we were in some major support resistance area here, kind of struggling through and muddling through, and we're starting to move towards some support area volume that if we break below, there's not a whole lot of volume down here. So an easy move for it to go down to the downside into this earnings release if it stays this bearish. And you can see the earnings have been negative. We've had a couple of quarters here of positive earnings, but this particular quarter last year was a negative earnings. It actually sparked a rally eventually that the stock market rallied, but obviously right now the stock market may not be in rally mode as we head into that April expiration. Let's take a quick look at the DMI indicators for UAA. And you can see the negative line crossing above 25, the positive line closer crossing below 20. If I bring up the other DMI indicators to go along with it, you can see negative on the oscillator here and way down here in the stochastic extreme. So negative patterns, bearish patterns all around on the DMI. If you look at the MACD and stochastics on a 2-line basis here, you can see both below the moving averages, MACD now crossing below 0, both the 8 and 17-day moving averages both crossing below the 30. It's a bearish crossover. You'd expect it to be weaker from here. And you see, finally, if I take a look one more time here at the Hakinyashi candles on the weekly chart. So this is just the last 2 years on the weekly chart. It's kind of the range of the last 5 years, which is so bullish here, really compressed it. That's why it looks as compressed as it is. I want to kind of zoom in, and you can see we've had good bullish candles, a few transition ups and downs, but the last few weeks have all been transitionary candles now that we'd expect more of a bearish move to come out of that transition, especially with all the other indicators looking the way they are. So how can we play that? Well, with volatility rising and this stock showing that bearish pattern, you can do a bearish vertical spread. You're not getting a whole lot of credit. This is a relatively high probability trade according to the options market to do a bearish trade on this. So it's actually the trade where we can look to do just buy a put option. You can see right now the at the money put is a $20 option. It costs $1.18. You can risk the whole thing because it's not very expensive in an option, and then see as it comes down towards this $17, $18 level. If it takes the next few let's go here to UAA, and then let's bring up. You can see, a 2 standard deviation move, which is, when your markets are falling and we're getting the pullbacks, you might get bigger moves than just 1 standard deviation. 1 standard deviation by April expiration is about 18.5. So let's say that, to split the difference between 1 and 2, let's say we go down to like 17 3/4 by April expiration. So let's bring up the Theo price here, and then bring up this to April expiration. Through Good Friday, and then down to that $17.75 level, so down $3. You can see that $1.50, the $1.18 option will be a double that $2.50. So, and if you risk half of that option, if you put a stop order half of that to get out, the market does bounce, and you get a decent reward to risk ratio because you'll make about $1.30 for a risk of about 60 cents or so, so more than that 2-to-1 reward to risk if it makes it down towards these low points within the next few weeks or so, which, according to the options pricing, there's definitely an opportunity for that to happen. Alright, so that does us for today. As always, thank you very much for watching. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread. Reply to anybody else's thread. Any questions or comments you have on today's video and anything we discussed, or anything we didn't discuss. You can be able to talk about that with other market scholars in our forums. Remember, you have to subscribe to our site to do that, but you can do that for free on our blog page like I showed you before. Again, thank you very much for watching. Have a great rest of your weekend, everybody. Remember to subscribe to our YouTube channel. Click that thumbs up icon down below the video and comment. Follow me on Twitter for more content in between videos, and join our Market Outlook community on marketscholars.com, as well as the one that we created on Facebook. Again, have a great one. We'll see you all on Monday.